Welcome to Force Financial, where geekdom and money meet. I'm your host, Commander Dave, and today I want to talk about money, everyone's favorite subject, or how to start building wealth. One of the best lessons I learned early when I was in college, I went to a financial seminar, and they mentioned how over your lifetime, you're going to earn a lot of money. And you don't really think of this, every day you're working, you're getting your paycheck. But when you sit back and do the math, you're going to make at least $1 million and probably millions of dollars over your lifetime. And just consider this example. Say you make a starting with salary of $60,000, you get a 5% raise every year, which is pretty reasonable. Over 40 years, you're going to gross $9 million. That's $9 million. So most of us are going to earn, at least $1 million, if not more. The trick is how much of that money you're going to keep. The first step of doing that is to put yourself on a budget. And it's helpful to think of yourself as a business. And like a business, you want to be profitable. And how do you determine your profitability? Well, you got to have net income. So you start with your revenue, which is your salary, and then you have your expenses. Now you have two types of expenses. You have your fixed expenses, like your home, your rent, your mortgage, your utilities, your car payment, your cell phone, food, and then you have your discretionary expenses. And this is really everything else, from vacations to Netflix subscription to going to the movies to going out with your friends to the bar, just buying clothes, anything that you really don't really need, but obviously you want to have some fun. So here's a sample budget, and this person has a salary, two paychecks a month. They're including a tax benefit for their mortgage deduction just to help them show their revenue on a more monthly basis. Then they pay their mortgage, they pay their dues, they pay the electricity, they pay their cell phone bill, they pay their cable TV, and they have a food allowance. So they have fixed costs of $4,300. And then they also give themselves an allowance for spending. This is a discretionary spending. You don't need to break out every dollar you're spending, but just to keep a rough, in general, in your mind, how much money you're spending. So this person's saying, I'm going to spend $2,000 on, all the fun things I want to do during the month. And then hopefully at the end of the month, they're going to have $1,000 of net income. Now, if you don't spend that $2,100, if you only spend $1,600 and $500 left over, you can put that $500 in the bank, or you can roll it over to next month. That's up to you. But you want to make sure every month you're profitable and every month you're putting money away. You want to be disciplined, because that $1,000, that should be your absolute minimum that you're saving. Any more, and you hopefully are saving more than that if you can, but you want to set yourself a minimum number per month that you want to be putting away. So one of the key things to look at when you're doing your budget is wastefulness. And I have a few quotes here. Steve Martin's quote's pretty funny. I love money. I love everything about it. I bought some pretty good stuff. Got me a $300 pair of socks, first sink, and electric door polisher, and a gasoline Howard turtleneck sweater. And of course, I bought some dumb stuff too. So just think about all the dumb things that you probably have bought or in the past, and things that you don't really need or use. That's the kind of thing you need to be looking at, because you don't necessarily want to be frugal, but you want to be smart with your money, because your money should be, besides your family, your most precious thing you have. And if you're wasting money, you got to start trimming that back. And one of the key things to think about is that you're saving your money. That's great. But if you just put your money under your mattress or in the bank, earning that 0.5% or 1% that banks give you right now, you're going to be losing money to inflation. Inflation's like a hidden tax. And as Yogi Berra famously said, a nickel ain't worth a dime anymore. Meaning the dollars you're putting away now are going to be worth less. They're going to have less spending power in the future. And just take a look at this chart comparing costs from 1975 to 2015. Some items really go much higher than inflation. Like look at public college. If you look at inflation, that cost from 1800 should only be 8,000 in 15 money, but really it's 18,000 because the college has gone up way higher than inflation. So it's interesting to look at that. But the point really is that if your money is not growing, at least at the rate of inflation, you're going to be losing money. So it's not just enough to save money. You need to grow your money. And that's where investing comes in. And investing, is a patient process. There's really two parts of investing. There's the patience and time. And I guess I could add discipline to that too. And anybody who tells you, oh, you can make money overnight or get rich schemes, be careful, because if it's too good to be true, it probably is. And I think that third quote, investing should be like watching paint dry or watching grass grow. If you want excitement, go to Vegas. And that's very true. A smart investor is looking for long-term returns. They're not looking for a short-term killing. This chart illustrates another principle in investing, and that is that the lower the risk, the lower the return. So, obviously we talked about putting your money in your bank. Your bank is very safe. It's fairly insured. So if the bank goes belly up, the government's going to make good on your savings. So, but the rate of return you're getting at the bank is very low. So you need to balance the risk-reward ratio and decide what's right for you. Now, I don't counsel going all the way to the right of the graph, because that's just too high. But you need to get a good rate of return. But remember, there's risk associated with that. So I mentioned, get rich schemes, and I think this is where people sometimes they get impatient because they want to double their money, triple their money. They hear stories about their friends, making a killing in Bitcoin or some other exotic investments. But don't be fooled. There's a tip here for Dave Ramsey: don't fall for get-rich schemes. It takes time and effort to build wealth properly, and that's very true. I can say from personal experience, it does take time and effort to do this. So this is just a graph showing my own personal wealth. And back in 1998, I only had $3,000 to my name, but through investing and discipline, I've been able to grow that number. And these percentages just illustrate the importance of investing, because my basis is really, that's the amount of money I put in, the raw dollars. So roughly half of my wealth was just the money I put in. If I never put that money to work, I'd have half the money I have now. So that's the concept I'm trying to get across here, that investing grows your money. And then where do my gains come from? Well, a quarter of my wealth came from dividends. And I'm a big proponent of dividends. And the other quarter came from the stock appreciation, the value of the assets I have appreciating. So again, the key here is growing your money is where investing comes in. This is where you can really jumpstart your dollars that you're saving. So there's different types of asset classes to consider, and everybody has their own method of investing. I have friends who invest in real estate, others in commodities like gold. I like equities. That's where I put my money, because I like having the control of investing in stocks and being able to just buy and sell when I want to and have that liquidity. But you can choose which is right for you, and ideally you might have some money in different buckets too. If you have a rental property and some stocks, diversification is really good. So the key here, one of the key things I want to highlight, is that your assets are not the stuff you own. Your furniture, your shoes, your clothes, your purses. That stuff is just stuff. It doesn't actually give you any return on your money. You're not getting any dividends or capital gains from those items. And even your home isn't really an investment either, because you're really just paying to live there. If you look at the historical value of homes really just basically keep pace with inflation if you're lucky, and also considering all the money you put into your home over the lifetime of your home to upkeep it, that's not really investing either. You want to have hard assets that give real appreciation, either pay you dividends or pay you interest, or will be a capital gain in the future. So the stock market is where I put my money, and we talk. I'm sure many people have heard this, but when you look at the S&P 500, which is a collection of the 500 most important companies in the stock market, they've averaged over a period of 1928 to 2014 a 10% return. Now, when you adjust for inflation, we talked about inflation before, that's a 7% return, but still, that's beating inflation, and that is a nice, and that's set. That 10-7% is what we're talking about, that steady growth. Because you're not getting 20-30%, you're not doubling your money. You're just over time just building wealth. The other thing to highlight is I have in blue here is dividends. Now, this does not include reinvesting your dividends, and dividends the S&P has a dividend rate around 2-3% right now. So you're getting out extra income that you can put back into, you can reinvest that money and grow your wealth even faster. Albert Einstein's famous quote is compound interest, the most powerful force in the universe. And that's very true, because over time you start building this momentum as more money puts in. You're putting that $1,000 from your budget, your savings, you're putting your dividends back in, you're putting your interest income back in. You're starting a snowball effect here where it gets bigger and bigger over time. And in the stock market, there's 11 stock sectors, and I list the 11 sectors here. And this is where broadly every stock is put into a bucket. I took this picture from Jim Cramer's show, because Mad Money, and he does a thing called Am I Diversified? Because what he's asking you is, if you have 5 stocks, are they in 5 different buckets in what he's asking? So here, if you look at this chart, you look at these 5 stocks, you have Facebook and Apple. Are they too similar? You can debate Facebook's more of a social media company, Apple's more of a cell phone company, but they are both technology stocks. And if you look at how they trade, a lot of times technology stocks will trade together, and that's why you want to diversify, because if one sector is doing poorly, another sector may be doing better. So when you start investing in the stock market in individual stocks, you want to try to pick stocks from different sectors. And this is my personal category of where I have my stocks. Now I'm heavy into dividends, which is why you see 29% is in REITs. REITs are real estate investment trusts. So basically you're investing in real estate, and a lot of my REITs are commercial or apartment buildings, and the REITs pay really good dividends, which is why I have a lot of money in REITs. But I don't want to have all my money in REITs. I want to diversify. So that's why I have money in telcos like AT&T. When I say stores, that's like Target. Energy is like ExxonMobil. Cigarettes is like Altria. So you have all these different, different buckets, and I like to try to move my money around into these different buckets. That way, if one sector is doing poorly, I think, like for example, utilities just recently have been going down. I have other sectors that may be going up. So overall, my portfolio is growing. And we talk about the S&P 500, and I want to highlight the S&P 500 because if you don't want to invest in individual stocks, you can just invest in the S&P 500. And you can do that through an ETF. The SPDR ETF is probably the most famous one. And what you're doing is when you buy into that ETF or a mutual fund which tracks the S&P 500, you're buying those 500 stocks. But you have to understand though, the S&P 500 though is weighted differently depending upon how the stocks go up in value. And recently, Apple, Facebook, Amazon, the tech stocks, and Google, they've done extremely well, and they're making up a huge percentage of the S&P now. You can see tech stocks make up a huge, the top 10 here, the tech stocks are highly representative. And we look at the chart here, information technology, which is the tech stocks, 25% of the S&P 500 is technology. Now, if you don't like technology, the S&P 500 may not be for you, but this is just understand when you're investing, know what you're buying. So if you're buying a mutual fund, you're buying an ETF, look at the top 10 holdings, look at what sectors they're in, see if that's where you want to be. Now, if you don't, and I want to make another highlight here on the S&P, this is the simplest way to invest in the stock market too. Every investor uses the S&P 500 as their benchmark. So if you can beat the S&P 500, that's hard to do. Most fund managers don't. But if you don't want to play that game, just buy the S&P 500. And one thing about mutual funds is you have to be careful of fees. And this is where the ETF, let me go back to the ETF. So the ETF fee is very low. Mutual funds, though, can have a much higher fee. And this chart is showing how you are losing money from those fees that mutual funds charging. And that's the nice thing about investing in individual stocks. When you buy your stock, you may pay a commission. Right to that, there's no fee. There's no asset management fee coming off the top every year, like in a mutual fund. A mutual fund has that hidden tax, really, that fee. You don't really see it, but it does hit your return, as this chart shows. Now, the nice thing about mutual funds, though, the positive is you can put money in automatically every month. And you get the power of dollar cost averaging, which lets you smooth out, the peaks and ups and downs of the market. You don't have to time the market. You're just buying it every month, and you're getting an average basis, an average cost basis, which over time is a good thing. So there are pluses and minuses, but the key is look at the fee your mutual fund's charging. If it's too high, if it's over 1%, find a different one because you can find better deals than that. And your 401k, if you're not in a 401k, I recommend you should be. In my plan, we have this Vanguard fund, which tracks the S&P 500. So I put about 1/3 of my 401k money into this fund because I want to have the S&P 500 as my return. Now they show that risk though. When you talk about that risk reward potential, they rate that as a 4. So the S&P 500 is risky according to the fund people. So just be aware of that. You can put your money in safer mutual funds like bonds or money markets or things like that. But again, I like the S&P 500. If you're just going to have to pick for a mutual fund, I'm going to pick the S&P 500. Why try to outsmart the market? I'd rather just have the market. And in summary, to build your wealth, start with a budget. Start with a savings plan. Think of yourself as a business. That net income per month, you want to put that money away. You want to save it. And then once you have some savings built up, start an investment plan. Buy a couple stocks. Find an ETF that you like. Find a mutual fund you like. And in other videos, we'll explore how to get started. But the first step is make that budget, start planning, and start saving. And that's it. Thank you for watching. This is Commander Dave. Have a nice day.